Welcome back to the Malden, Massachusetts acquisition. Part 1 introduced the opportunity. Part 2 is about understanding the mechanics behind why experienced investors are paying attention. Successful investors don't solely focus on how much money they make. They also focus on how much they keep. Because the difference between earning income and building tax-efficient wealth can become substantial over time. Following the strong engagement from our initial launch, we're continuing the conversation with Part 2 of the Malden webinar series. This session takes a deeper look into the greater Boston market fundamentals and the strategic tax advantages behind the Malden opportunity. Located just minutes outside Boston, Malden remains one of the most supply-constrained self-storage markets in the nation. More than 247,000 people live within 3 miles. Over 57% of residents are renters, and demand for storage continues to outpace supply. This is an institutional quality self-storage asset operated by Extra Space Storage, entering at approximately 90% occupancy, with rents still below market, meaning upside may already exist within the current operation. But this conversation is about more than occupancy and rental growth. It's about how investors evaluate opportunities through a tax-efficient lens. We'll explore how bonus depreciation strategies may create significant first-year depreciation potential, how some investors utilize real estate to improve after-tax cash flow, and why real estate continues to play a central role in long-term wealth preservation strategies. Alongside the storage facility sits a fully leased industrial warehouse generating stable and consistent income within the growing last-mile logistics ecosystem. This creates a rare combination of location, demand, immediate income, tax strategy, and long-term upside, all within one opportunity. And as institutional capital continues moving into markets like Greater Boston, the time frame to participate in opportunities of this nature can be limited. Today is Wednesday, June 3rd, 1 p.m. Eastern Time. Sergio Altomare, Jordan Canino, and Patrick Ulrich will guide you through the market dynamics, investment structure, and strategic tax considerations behind the Malden opportunity. Welcome to Part 2 of the Malden webinar series. And now let's begin.
I'm now going to start the deck, the presentation. Feel free to pop into the chat where you are from. And if you have questions throughout, please feel free to include it in the question section or directly in the chat. Happy to answer those during the presentation as well as at the end. Here we go. Okay, so some of you on here I know have some background on the project, but we're going to start from scratch and fill you all in for those who have no idea about the project. Like I said before, please ask as many questions as you want. But we are acquiring a dual income asset in the Boston market. It is comprised of 50,000 square feet of self-storage, which is Extra Space managed, and 25,000 square feet of industrial warehouse space, which has a lease with Uni, a nationwide last mile logistics company, and that lease expires in 2031 with a 5-year renewal option. We are targeting a 5-year hold period, 2.2x multiple on invested dollars, 19% target IRR, and roughly a 24% average annual return. Here's our disclaimer. It basically states that many of these assumptions have been verified by third-party sources. All projections are hypothetical and based on our estimations and assumptions, and there is no guarantee to these returns or performance. So investment highlights. We're buying a dual asset that has both industrial and self-storage. As I mentioned, the storage itself is about 90% occupied, and the industrial lease is newly inked and expires in 2031. We're buying it at a very attractive basis, 6.43% cap rate, which is very tremendous and allows us to have cash flow from day one for our investors here. We're buying into a very significantly high barrier to entry market with 4.2 square feet of storage per person in that market, with national average being 9. Very dense market. There's a significant household income, median household income of 99,000 here, and a high renter population, which are both great drivers for self-storage. There's rent growth that's embedded in the rent roll currently. So we're about 10% below market rents here. And so part of the business plan is to drive those rents. Reason being, this asset was managed for many years by a mom and pop operator, and the prior owner and seller brought in extra space. It takes extra space some time to get the rents up to market, and they're already moving in that direction. As of today, we're about $26 a foot on average, with the market being around $30 a foot. That is up about $1 per foot over the last 6 months. So the manager and extra space is moving in that direction. We just need some time to continue to season the asset. And then lastly, there's strong tax shelter for this project, which Patrick and I are going to get into later. But basically, you're able to write off 98% of your invested dollars in this project, 86% in year 1, and then years 2 through 5, an additional 3%. A little bit of background on us, for those of you who don't know, we've been around about 13 years. Over the last 13 years, we started in the residential side and multifamily. About 8 years ago, transitioned to self-storage. Over the last 8 years, we've done 25 projects across 10 states and currently own and manage over 1 million square feet of storage. Historically, across our 9 exits, we have hit about a 25% IRR on average. We have now exceeding this number through this project. We're approaching almost 290 investors. 50 million of equity has been invested, and our total assets under management exceed 200 million. So today, we have myself and we have Patrick Ulrich. I'll introduce myself real quickly, but I've been in real estate about 20 years, self-storage over 10. Most recently, in the last 6 years or so, I've run capital raising and investor relations for a couple large groups within our space. I joined Hearthfire a little less than a year ago, and it's been great. We have a pretty vertically integrated company. We have my team, the investor relations team. We have a development team, an acquisitions team, an asset management team, a finance team, and that is all overseen by Sergio and Corinne, who started the company 13 years ago. And Patrick, if you want to introduce yourself.
Yeah, hey everybody. I'm Patrick Ulrich. I'm a tax partner here in Cohn Resnick's Chicago office. Cohn Resnick, for people who may or may not know, we are the 14th or 15th largest firm in the country, depending which numbers you're looking at. We have nationwide coverage, and commercial real estate is by far our biggest industry. I would put us in the top 5 for commercial real estate practices across public accounting, despite being the 15th largest accounting firm. Real estate in some capacity makes up about 50% of firm revenues. So, this is where we specialize and really try and drive results and bring, expertise for both the owners and operators of properties.
Awesome. And thanks for being with us today, Patrick.
Happy to be here.
So back into the property. It's located about 6 miles to the northeast of downtown Boston. The property itself is around 5 acres with 75,000 square feet under roof, with 50,000 of that being self-storage, 25,000 of that being industrial warehouse. The storage is all interior climate controlled, and occupancy sits around 90% today. The original building was built in 79. And last year, there was a full renovation of the property, including a new roof, all new paving, new HVAC, brand new office, It was rebranded to self-storage, extra space storage, and repainted. And so the asset is pretty much turnkey with no deferred maintenance or capital expenditure needed. Here's a picture of the site map. You can see on the bottom left, you have the self-storage. To the right of that is the industrial warehouse. And then in the back of the property, there's an additional 1.5-ish acres that can be utilized in the future for maybe more drive-up units or maybe even an additional building for the industrial tenant. But it gives us some flexibility. If you look just to the right of the property, there is and just to the east, there is a 200,000 square foot Amazon warehouse, which just speaks to the quality of the market here. Here's some more photos. You can see the newly renovated and brand new roof. We'll be adding solar to that roof shortly here in our business plan. That lease is underway, but it's a great roof for solar, and we'll be getting about $65,000 in net revenue from that effort. Here's some more interior photos of the renovated facility. Top right, you can see the new office. Bottom left is a loading dock. And then on the right here on the bottom, you can see the industrial warehouse tenant. We will be using Extra Space for management here. Extra Space manages almost 4,000 facilities nationwide. We use them for a significant chunk of our existing portfolio and have a very strong relationship with them. When it comes to driving occupancy and revenue, there's really no one better in the industry, and they have a lot of brand recognition throughout the country. Specifically within this market and within the 3-mile radius, they manage 3 of the 5 competitors, and we'll be able to drive our occupancy and revenue even greater, knowing that they have a really, an inside track at all of the facilities in the market with the existing occupancy, the data, where they should be charging rents per unit. But we're really comfortable in their execution here, and we're excited to have them. It also helps that they were already in place, and we didn't have to rebrand the facility and repaint it with new signage or anything. So it was a seamless transition there. A little bit about the submarket, and I mentioned this earlier, but the square feet per capita here is about 4.2, national average being 9. So it's a severely supply constrained market. And there's also a moratorium on future storage within the Malden area, which means that if you did not submit your plans for prior to July of 2023, they're not allowing any more storage today. That could change. Moratoriums can be lifted, but we feel really great about the fact that there's not any threat of new supply within the trade area. And then on the other side of the asset, which is the industrial market, there's about 3% vacancy for industrial warehouse in this space, and rents are about $30 a foot triple net for that type of space in this market. So it really provides us good value for our existing industrial and the potential to add some more in the back as well. Here you can see a local multifamily map. There's 2,000 apartment units within roughly a mile of the site. That is always a good thing to know. And if you look at the Quarry Stone and Chase, those are moderately new within the last few years. So when we look at a new market, it's good to be surrounded by housing, but to be surrounded by multifamily is even greater because there's more transient tenants in those facilities and in those buildings. And so, yeah, you can see here in the map how close it is to our project. Here are our 5 comps within the trade area. Overall, we're about 10% below the market. So we're going to be able to drive rents for 10 by 10 units. We're significantly below the market, and Extra Space has already started increasing them, but we'll be able to increase our GPI and our rents by increasing our 10 by 10s on the rest of our units. As I mentioned, Extra Space is 3 of the 5 comps here, which helps us with driving value and driving price and definitely occupancy. If someone comes to the Eastern Avenue facility looking for a 10 by 10, they're more, and then there's no 10 by 10s available, they're more likely to send them over to our property than they are the U-Haul or the public storage here. So you get some benefits of that. And it's always good to be the market leader or have your management company be the market leader in any new opportunity that we look at. And we're really excited about that as well. Here's our overall sources and uses for the project. So we have about 67% senior debt. We're putting up about 3%. And then the remainder of the project will be funded through limited partner equity. We have an existing network of about 290 investors, where there's a handful that are investing in this project. And then a lot of folks are investing in this project through our channels of meta ads and organic leads. And so we're really excited about bringing this to the market. The overall purchase price here is comprised, takes up about 97% of the closing cost, with the remainder being interest reserves, acquisition fee, and debt origination fee. Our financing for this project is with Citigroup, about 6.3% as of today, fixed rate financing, interest only for the 5-year hold, which allows us to distribute cash flow from the first quarter that we own the property. Our debt service coverage here is 1.25, and going in, it's about 1.55. And so we have plenty of coverage there to service our debt. Here's a little bit more about minimum investment being $50,000 here. To date, as of this morning, we have about 6.1 actually committed. So available equity for this project sits around 1.25 million. If you invest in this project, you can invest through an LLC, through a trust, potentially through a 1031, through a self-directed IRA, or just in your individual name. Just to mention our fees on this project, we're taking 1.5% of the purchase price as an AC fee, 1.5% of the annual revenue as an asset management fee, and our disposition fee is 1%. Here's a little bit more about our tenant, Uni Uni. They are a last mile logistics company based out of British Columbia and Vancouver. They were founded in 2019. Over the last 3 years, they've had 7,000% revenue growth, and we're really comfortable with them as a group. We just yesterday had a conversation, Sergio and our team, with their group, and we feel really comfortable with them going forward. They have no intentions of leaving. And we're getting $27 a foot triple net from them, which is super strong in this market. Still slightly below market, and we have 3% rent growth per year, but we're comfortable making about $700,000 per year in rent from them. Here's our projected returns. So as you can see, years 1 through 5, we have cash return and cash flow from the beginning. It should be about 6% in year 1, approaching 10% by year 4. Those are paid quarterly. So if you take that percentage and you divide it by 4, that's the amount that you'll be receiving. The other thing to note here is our waterfall structure, where we have a 10% preferred return annually paid to the limited partners. We're the general partner, so we see none of that. The next stage of the waterfall, up to an 18% return, it is shared 75% to the limited partnership, 25% to the general partners, and then above an 18% return, we share in that profit 50-50. So we're really incentivized as a company to exceed that 18% because we share in the waterfall 50% above an 18% return. How that all shakes out is roughly a 19% IRR in this project and a 24% average annual return. Here you could just see a little bit more about the cash flows based on a $200,000 investment. You're going to get distributions paid quarterly, and then when we sell the asset, you have the return of your principal and additional profits from sale. So for a $200,000 investment over the course of 5 years, your $200,000 turns into $440,000. And then we're going to get into the next part shortly about the taxes, but there's significant depreciation on the $200,000 over the course of a 5-year hold, including 86% in year 1. You're looking at offsetting and sheltering $197,000 of your invested dollars. I guess now we could just roll in. There's superior tax benefits to this project. We do a full cost segregation study, which we already had done, which tells us how much of the asset can actually be depreciated and through 15 5 and 1 year life assets. And so I guess, Patrick, I'll let you.
Yeah, let me jump in here.
Yeah, jump in and talk about the cost seg study process, and then, also the bonus depreciation and how that works for folks.
Yeah, absolutely. So, well, let me start with the first key, full pass through. So this is going to be a partnership for tax purposes, which means any profit or loss of the company is passed through to its investors, proportionately to how the waterfall would work. That's very important to note because, in year one, we would anticipate, very significant tax losses, not cash losses, on the investment. And the driver of that is bonus depreciation on the personal property that exists in this particular location. How we find that is through what Jordan had mentioned, a cost segregation study. A cost segregation study effectively takes all of the building components of an asset acquired and segregates it into various asset buckets to determine its depreciation for federal income tax. The One Big Beautiful Bill passed, about a year ago now, included an increase back to 100% bonus depreciation. So that's very good news for everybody. What makes this asset actually highly attractive is the fact that the interior self-storage portion of the property is modular and has effectively movable walls. Which means that when a wall or building component can effectively be picked up and moved, it becomes personal property in nature and not building property in nature, right? So if you think you have a fixed wall, structural, connects to the ceiling, that's just going to be part of the building itself. Buildings are depreciated over 39 or 40 years, pending a few hyper-specific things. That's obviously your slowest, return on depreciation. When it becomes movable, it actually becomes 5-year property. And according to the One Big Beautiful Bill and the current codification of the tax code, anything with a 20-year useful life or less is eligible for 100% bonus. We think through, some of the cost segregation providers involved here, that 30% of the initial purchase price could be, or it might even be slightly higher than that, Jordan. I'd have to go back and look at the numbers, but let's call it 30% of the original purchase price would be these various modular personal property components and not the building itself, because the building itself is really core and shell than the actual modular self-storage components within it. And ultimately, because of how much is levered here, we're looking at 67% debt. That's where we find that 80 some percent in year one of your investment will be returned, right? Because we're anticipating writing off effectively 30% of the building through bonus depreciation, of which 33% of the building was funded through equity and 67% debt, right? So capital accounts, will get a huge tax advantage in year one because of those, sophisticated, or those components of the building that are highly attractive in nature, as compared to potential outdoor storage or indoor storage where it's a fixed walls and non-modular. Those are all significantly more building components. It would be depreciated over much longer useful lives. And would effectively, really make this a much more tax advantageous asset.
Awesome.
All right. Yeah, and I'll keep going if people don't want to hear too much about tax, but effectively all of the initial losses are going to be ordinary losses in nature. It means they'll come through as rental real estate losses. There is a caveat there that these losses would be passive in nature. You would need to contact your tax advisor to understand, if passive losses are something that are beneficial to you. Effectively, what happens is you take a loss and it's subject to the passive activity limitations, which says, passive losses can be used against any other source of passive income. There is a difference between passive income and investment income. things like interest and dividends from a stock portfolio would not be considered passive in nature. But other passive investments, such as those with Hearthfire, would be passive in nature, right? So you get a Schedule K1 showing, your significant tax loss in year one. It goes into your tax return. You figure it compared to all of your other sources of passive income, and it wipes all of those out as low as it can go, right? So if you have $1 million loss and you have 800,000 of passive sources of income, you would reduce all of your passive income in year one, and you would have a $200,000 carryover to year two, right? And then you go through the same thing, except you use your carryover loss, to offset it. Passive losses do become free in nature whenever the asset is disposed. So you would be able to use that passive loss against gains from the sale of it, in addition to any other sources of ordinary income. So there could be a rate play there in which your passive losses, become freed and offset other sources of income. And then you're left paying tax on capital gains rates versus ordinary rates. Ordinary rates are generally going to be at your marginal tax bracket. Highest bracket is 37%. Capital gains rates are either going to be 0, 15, or 20%, depending on your personal tax bracket. So above the highest marginal tax bracket, capital gains rates are 20%. Below the highest marginal bracket, capital gains are 15%. And then if you're in the lowest 1 or 2 brackets, there's actually no tax on capital gains. I would think on an exit here and, potential gains, that there would be limited people who end up in the 0% bracket. So I often leave that out, but it is possible somebody ends up more in the 15 or 20% bracket, which is going to be significantly lower than your ordinary rates. Right. So if you can save tax dollars early, there's both a rate play in which you save it at a higher marginal rate. You could be saving tax at 37 cents on the dollar and then paying it on the gain on dispositions at 20 cents on the dollar. There would be some depreciation recapture of buildings. Those are going to be generally taxed at 25%. So there could be a slightly higher capital gains rate, but the 25% recapture rate is still always going to be lower than your marginal tax rate. So there's still a significant play. And then, there's also the time value of money, because these losses are occurring in year one, and you have the ability to offset other sources of income you otherwise would have paid tax on. You can defer that tax dollars a number of years until it recognizes again as capital gains. So there is both a rate play and a time value money play. Saving money today to pay tax at a lower rate tomorrow is generally always a good strategy. Allows you to keep more dollars invested, not take money off the table to pay taxes if you have an investment portfolio. A number of strong benefits. I will caveat this is highly individualized specific based on your current tax situation, what sources of passive income you have, what category in nature, a portfolio may look like, whether it be, interest, dividends, and what I would call investment income, or actively earned wage income versus passive income is essentially the 3 buckets. So highly encourage you to talk to your tax advisors, to ensure that you have a use for passive losses. And if you don't have a use for passive losses, they can carry forward until the year of sale. And again, you can pay tax on the income generated from this property primarily at capital gains rates and not ordinary rates. So if you don't necessarily have a use for passive losses immediately, it's not all a bad situation. It could still end up in a very advantageous tax position overall on this asset where you're exiting and paying all of your tax associated with the income at capital gains rates versus ordinary rates on something that maybe doesn't have strong tax attributes of losses up front.
Super helpful.
Okay, I kind of covered all of this because I like to just talk, and I can get lost in the tax law here. But again, the more losses we can generate up front in year one, and then use them either against this project or other sources of income you may have, the timing and acceleration is incredibly, valuable. Again, tax dollars saved today to pay tomorrow at lower rates because of the capital gain treatment is always a good play, right? So if you're sitting on, pieces of investments that are kicking off passive income annually, and you're having to write a check to the government quarterly or on April 15th to, pay back some of your returns from those investments, this is a good way to hold on to those dollars, reinvest those dollars elsewhere, and see continued growth, and then pay the tax ultimately on the back end, after exit. All right. So, I mean, another, this could qualify for, 1031 treatment on the back end. 1031 is deferral of gains on sales of real property. This would qualify as real property. It's not necessarily going to be, certainty that a 1031 will be done on the back end. If there's a number of people involved who would want to look at a deferral strategy, that's something, Hearthfire and others can put together, but as we're kind of talking, and the tax, or the One Big Beautiful Bill permanently codified bonus depreciation at 100% depreciation, there's actually a lot of instances where depreciation offsets to gains are a better deferral strategy than 1031. 1031 requires that all of the cash be reinvested regardless of the gain. Any cash taken out from a property that you're doing a 1031 on through a qualified intermediary would qualify as what they call boot. Boot is taxable to the extent received. So, if a property would cash out $500,000, you have to reinvest the full $500,000 regardless of what the gain is. If you take out $100,000, your gain is $100,000 and the rest is deferred. If you don't look at a 1031 and you say, okay, I'm going to get $500,000 of cash back, but my gain's only $200,000, I could invest in another project like this. I could take $300 of cash back to me, put $200 into a project that's significantly bonus depreciation heavy, virtually defer the entire gain, and now I've cashed out $300,000. So there is a number of strategies that could work better than a 1031 exchange. But when, this deal sort of gets to end of life, it's something that could be considered if the right facts and circumstances make sense for a number of investors that wish to participate.
Yeah. And I would just add, if you're thinking of rolling in a $50,000 investment, not only is that not worth your time with the qualified intermediary and the timing constraints, but you can accomplish the same thing on the exit with a reinvestment in a project like a Malden. I can't promise we're going to have as high of a depreciation as this Malden project, but utilizing myself and Patrick as a resource as you navigate these situations, feel free to reach out. I almost always help people navigate their tax situation and analyze it from the 1031 perspective, a bonus depreciation perspective. But yeah, that was really, really helpful. And if you guys have any questions on this afterwards, we can share the deck. We're going to share the video, but we're happy to provide you with some color on your specific situation. We can't be as, in tune as your CPA, but we can give you some guidelines of what to think about as you're navigating this process for sure.
We would always highly encourage everybody to vet everything through their CPA. Couldn't encourage that enough. Everything is hyper specific. I can talk about how it runs through the project and the general rules that are applicable, but nobody else will be able to give you better advice than your CPA on what types of losses would benefit you.
Yep. So yeah, I think we spoke about most of this, but what we offer as a company is direct ownership and institutional quality self-storage and assets. We're happy to, have one-on-one conversations after the call. A lot of people in the chat have asked to have the presentation sent to them. What we're going to do is send a copy of the video of the presentation. And if you have further questions, there'll be a link that I'll provide in a second where you can just book an appointment on my calendar. That's right here. If you want, one sec. If you want some more information on the project itself, here's a link to get more details about the project. In terms of tax questions, feel free to contact me. Patrick and I are pretty close. So if you have a question, I normally loop him in if I don't know the answer. And we can take, from a tax perspective, that from there. And what else? Anyone else have any questions? Let's see in the chat. With the current economy, war in Iraq and gas prices, does this investment stand to be production cost? So generally, self-storage is a recession-resistant asset class. In the face of the last two recessionary environments, occupancies pretty much stayed. They actually went up. Rents were pretty flat, but historically, in a good economy, people have more stuff and they need to rent more storage. In a bad economy, or when bad things happen in life, like death, divorce, dislocation, those are significant drivers for self-storage. I would say you wouldn't, in a market that was growing in rents, if there is a large macroeconomic shift or effect, you might not be able to get to the rents as fast as you would have anticipated in your model. But storage, historically, assets appreciate in value, rents go up, and especially in supply-constrained markets like Boston. So, yeah, that's kind of the answer to that. Is that 6 to 9% yield to LPs part of the preferred returns? So the preferred returns, the 6 to 9% yield goes to paying the preferred returns. So you're going to have some current pay and some accrued. Especially in year one, we anticipate about 6% current pay, 4% accrued. And then as you get down later in years 3 through 5, you're going to have close to 10%. So we're able to pay off the full pref. And then when we sell the asset, we're going to first pay back any accrued preferred return. Then we return the principal, and then we pay additional profit. That is, whatever your pro rata share is. Are the quarterly returns during the hold considered passive real estate income? Yes, they are. Right, Patrick?
Returns.
Preferred return.
Well, the returns, the distributions from an investment are not income themselves, right? It's a distribution of equity out of an investment. In pass-through taxation, everybody is passed through their share of profits and or losses of the company. Because there's always going to be non-cash deductions and depreciation. We would anticipate that, cash flow exceeds taxable income.
Exactly.
But you can't say I got a $10,000 distribution, I have $10,000 of income. Your share of income will be based on the performance and the actual profit and loss of the company, in which we always look to non-cash deductions to minimize as much as possible. So every year you will get a K1 showing your distribution amount and your share of profits from the company. Your share of profit or loss from the company is what you would be taxed on, not the distribution amount. The distribution lowers your basis within the investment. So it's not itself. The quarterly returns themselves are not one or the other. They're a distribution of your basis in the property. It's then the activity of the property, which could be tax positive, in which, we ideally have other, these carry forward losses to use against it, or you've already saved the tax dollar from those carry forward losses, and you may be subject to some tax in those years.
Exactly. So had you have used the 86% in year one to your personal portfolio of your other rental properties, you might have a tax event you personally, where someone else who had carried forward that 86% might not have any taxable tax liability. So it really depends on the individuals, how they utilize the depreciation on their K1s in year one specifically. Is this type of investment a lucrative retirement investment for a 60-year-old young person's game? I would say, it's a 5-year hold period. The average age of our investors is probably 55 years old. It's really Are you looking for an income producing asset, which is what this one is? Or do you want a growth opportunity, which we have a full growth opportunity, which is really ground up development in our arena? It's really up to you. I would say it's not a young man's game at all. Most of our investors are looking to figure out their retirement. Some of them really reinvesting some of their IRA funds through a self-directed, but it's really what your appetite is and what you're looking to earn on your money. Just know that these projects are generally 4 to 6 year holds, and we anticipate this one being a 5-year hold period. Great questions coming in here. So what I'm going to do now is I'm going to share a second poll, and then there's also a QR code on here. If you want to just scan the QR code, it'll take you directly to our project site. I know I also shared a link to it, but the QR code is cool and it works well. If I don't have any other questions, Patrick, this could be the first webinar that I've been a part of that ends exactly on time.
Amazing. Oh, you love those.
I know how busy you are.
It's like we almost scripted it perfectly.
Yeah. I love it. So I don't see any more questions. I don't see any more comments in the chat. I will have this recording sent to all of you. And then if you have any questions in the meanwhile, you're interested in investing in this project, now is the time. We have, like I said, about 1.3 million left of capacity here, with 6.2-ish have been already committed and 4 million funded already. So please let me know sooner than later. Very rare opportunity to get into an amazing Boston market with a maturing, almost stabilized asset and very significant tax advantages. So I guess without further ado, Patrick, thank you so much for your time. I really appreciate it.
Awesome, guys. We'll talk to everybody later.
Yep. I got someone typing in the chat, so I'm going to wait for him. Send me info, please. You got it, Steven. I'll send it to you right now, okay? Thanks, guys. Have a great one.
So long, everybody.